Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to rip through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it together. It's generally related to three different topics: wealth building, commodities, and/or financial topics. So let's dive in, take a look, see what people are sharing. If you want to follow me, it's at @Finance. And if you want to join our community, findinghighvalue.com. I dive deeper into all these sectors, looking for potential investment opportunities and sharing them with everyone in the community. We do have a special going on. Special is the coupon code if you'd like to join. So Peter Schiff says, if Trump's secret agenda is to crash the stock market to bring down long-term interest rates, the plan already failed. The yield on the 30-year Treasury is now above 4.75%, its highest since February 19th. So the plan to crash the stock market is now crashing the bond market too. And that's crazy. Usually the response is that people run into bonds if people are fearful. I don't know if other countries are selling their bonds on the long end and causing them to go up. Um, that's difficult to know. I don't know if he's ticked off other countries and they're going to say, you know what, we're going to raise your yields on you. We're going to be the anti-plan to your plan now that you're messing with the tariff crap. Very well could be China. It could be other countries that are not happy in the situation that they're in. Difficult to say, though. If it's not them, we got a problem, Goose. We got a big problem if it's not them. That means that if they're not the ones that are selling them, then I mean, it's possible what they're trying to do is maybe squeeze a bunch of supply as much as they can at these low interest rates and refinance as much as they can as fast as possible, which means that interest rates will naturally go higher if they're trying to move the big chunk of bonds to the 10 and the 30. So, I mean, it could be them, and there's just so much supply that the demand, it overwhelms the demand and interest rates continue to go up. That also could be a potential outcome is they just have to roll over so much and they're already doing it. There's just too much supply. Frank says, I may be wrong here, but I don't think China will succumb to these threats. My guess is they will refuse to be bullied. So if I'm right and Trump goes through with this latest threat, the world is in for a tariff war, and that will make Smoot-Hawley look like a garden party. Hope the world is ready for deep recession or even a depression. Trade wars have no winners. This is silliness to the extreme. And Danielle Cambone says, breaking news, Trump threatens new 50% tariff on China if Beijing doesn't remove retaliatory duties. I don't know, guys. I don't know how you can price this in. I mean, Smoot-Hawley, that was tariffs put on in the 1930s. It obviously did not help the country one bit. Um, but the 1930s was a different market condition. We had a deleveraging event where a lot of bad loans were going bankrupt and bust. But I don't know. If, I don't. We're not in that type of situation with the real estate market like we were in the 1920s, and then eventually in the early 30s. So it's not a straight comparison. Definitely not that. But if we do get into a trade war and these tariff wars, I should say, well, I don't know how you price that all in. And I think that's what the market is trying to grapple. It's like there's so much uncertainty and so much things going on. And the potential for recession out in the future, if all this stays the way it does, which I highly doubt it will, is all baked into this uncertainty cake. Silver Surfer says almost a certainty that we will put in the failed DCL today. This should confirm in time unless we go lower tomorrow. That said, I'm expecting this rally may only last 5 to 10 days before it tops and left translates. The bounce off the lows was decent, stopped just short. So yeah, I agree. We've got big selling pressure. It's going to be like an ABC correction. And then we probably come down to 28, 27, something like that dollars for silver. Definitely think that's a high possibility. Um, With the yield curve uninverting, that is generally really good for gold. Silver, it's not as good because it's viewed as a precious metal and a industrial metal. And if people look at things negative from the industrial side, it can bring down silver, and that's where you see the silver to gold ratio or gold to silver ratio go above 100. That's kind of what it's signaling. Fear, the safe haven trade of gold, and then the industry side or industrial side of silver. So if they were to come back and do QE and print money, that's generally when you get the big move upwards. What do bonds know? Last 20 years, large equity market risk off events have always brought in the flight to quality buyers of long duration US Treasuries. Not this time. Book ideas: How to Listen When the Market Speaks to Amazon. So this is your 30-year bond yield. See how they've always dropped? Lehman, Brexit panic, and then we've got the COVID. See how they all went down, 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 down. Now, in 2020, we broke, like that was the bottom of the bottom, and we broke the downtrend, which was the ultimate bottom in 2020. We started breaking upwards, a shoulder, head, shoulder. So it's an inverted head and shoulder bottoming pattern. And we broke to the upside of that in 2021, 2022. Ever since then, we've had higher lows and higher highs for yields. The 10-year, the 30-year, doesn't really matter. Now that we've got this fear in the market, it's not really falling down very much. In fact, today, which I'm recording this on Tuesday, yield shot higher on the 30-year, over 2%. So, I mean, this is a different dynamic, guys. We're in a different world here. It's not like this world before. And the yield curve may not even matter as much as what I think, because that worked for the last 40 years. What looks, going forward, it might be a different signal. And everyone's using the wrong signals, perhaps. This is a long-term S&P 500 to gold ratio. And you can see the Federal Reserve was created in 1913. We had a nice little resistance line, broke out in the late 20s, early 30s. So SPX, and then it came all the way back down to a very low level in 1940. We had another big surge for the S&P 500 in the mid or early mid 40s, so 1943-ish or so. We went all the way up to 1960s. This peak in 1960s rolled over. We had a big move lower where gold outperformed and went all the way to a low of 1980. From 1980, 81, that was the bottom of the S&P 500. That's when you want to go all in. So all in 1943, all in on 1981, and then you went all the way back up to the 2000 peak. This was the largest, biggest move of all these bull markets in relationship to gold. Then we rapidly fell from 2000, 2001, all the way to 2011. That's another cycle peak. We had in this middle here a move higher from 2011 all the way till about 2024, 2025. Now we've broken to the downside of this ratio. What does it mean? What's the ramifications of this? It means that we're entering a commodity bull market. Here's the problem in the short term. Commodities are selling off like everything else because we have margin calls and there's all these other things going on, the uncertainty, potential recession. I mean, there's everybody's running, mine's going wild. Now, here's another thing to think about, guys. They released this information when this broke out. It's almost like they knew what was coming to some degree. And you could obviously put a trend line through here too as it broke down. So this is all happening. Gold's going to be a hell of a place to be. Same with silver. Silver is going to absolutely kill it. And commodities in general. It's all coming. Now it's just, when is the fear going to subside where we can get good entry points in a lot of these different commodities? Coming down, we've got Kevin Bamborough. It says the current system of letting banks own bonds based on fractional reserves is a scam. Plain and simple. The average guy pays tax and it flows to interest rate payments that flows to banks. But the banks get to own the bonds due to the system, the design of the system. They don't actually have the money. People need to understand that they are being ripped off by the system and then take steps to change it. That's also how government is taking advantage of the system. It's all rooted in the design of our money system. It's all rooted in the design of the money system. It used to not be that way. Gold and silver was our money system back in the day, but now since it's not backed by gold and silver, they just print whatever the hell they want. I mean, they just let it rip, and then they can create money from nothing, they can do that through two ways. One is bank lending, and two, the Federal Reserve just prints it. And then the banks own the banking system. So the banks are all part ownership of the Federal Reserve banking system. So if they were to go too aggressive, and let's say they remove the reserve ratio for lending. So let's say they get too leveraged, they go 40 to 1, 50 to 1 on the leverage, and they have a small loss which bankrupts them. Then they just say, "Hey, Federal Reserve, recapitalize us. We'll just sit here and do nothing. We're too big to fail." None of that could be possible if you had a gold and silver backed currency system that was more rigid. It wouldn't be possible to do that. And the system would be far more resilient because the bubbles would be smaller in either direction. China FX send it, so foreign currency exchange is ripping higher. China offshore spot currency. Here's Joseph Brown. I have a couple from him. I guess some people are trying to go at this guy, and he says, what we are seeing now is the exact opposite of tough decisions that will be beneficial long term. If you want an example of actually undoing the harm, look at Milei in Argentina. You can't use more government to fix problems caused by big government. You just start slashing. And this is when you've been driving in the wrong direction for a century, you have travel a long way just to undo what's been done. Here's another one from Joseph Brown. It says, when the government increases control over the flow of resources in an economy, that's socialism. In other words, national socialism. I wonder if anyone has come up with a shorter word to blend both together. And it says, friendly remind, this is nationalist movement, not a libertarian one. Libertarian one. So what we're doing is we're saying we're not competitive on the world floor. We don't want to get more efficient, but we'll just tax a whole bunch of other people. I've always looked at that as a negative way to respond to something. Adding more taxes on top of taxes on top of taxes does not benefit the citizens of that society. What benefits them is to remove all of those taxes and to get out of the way. Get out of the way. Let efficiency win. But what happens is people say, well, who's going to create these jobs? If government creates jobs, it is stealing from wealth in the system. They have to steal it from someone else and then redeploy it to some job of whatever their choosing is. The best thing you can do for the economy is to get out of the way and never create those jobs in the first place that are government. You want jobs that create wealth and build wealth. And then you want those people in society to be rewarded for doing it. You can't have people hired by government that get paid 2 or 3 times the amount that private citizens or private workers get paid. Because eventually it's just going to all blow up. And I think that's kind of where we're at. It's blowing up. Triangle Investor says the most volatile energy investing commodities according to Grok. So this is the list: crude oil, natural gas, gasoline, heating oil, and uranium. Do you agree? So I did an analysis on ratios to find the most highly leveraged commodities. Those are the most leveraged: crude oil, natural gas, and uranium. I didn't look at heating oil and I didn't look at gasoline. There's no real great way to play those. I mean, you could do refining, but I don't want to play it that way. But my favorite is crude oil, natural gas, and uranium. Those are the most leveraged of everything, and that's where I focus a lot of my efforts at. I also think that the epicenter of the crisis is going to be crude oil. Crude oil is going to be the epicenter of the crisis over the next decade. Um, One of the biggest benefactors of the epicenter of that crisis will also be precious metals. And the reason that will be is because we don't have an alternative to store wealth. There's no alternative. So if your bond market eats it and your currencies eat it, well, where do you go? Everyone's going to squeeze into precious metals, and I don't even think it matters which ones. Platinum will get squeezed, palladium will get squeezed, silver will get squeezed. The banks will get absolutely smoked. They'll get smoked by their big shorts on all of them. And crude oil is going to be what does it. And the way that's going to happen is the design of the system must grow. It has to grow. It needs more credit to be coming into the system in ever greater quantities to survive. And when that happens, where we hit a supply constraint in energy, and I think it's going to be right on crude oil, it won't be able to grow at the same speed that the system needs. That disconnect will cause massive inflation. If we get massive inflation, what you're going to see is you're going to see the long end of the bond market, the 10-year and the 30-year, is going to start to go up rapidly. If it starts to go vertical, that's the beginning of the crisis. You may see the currency market get hit next. And then what you'll see is you could simultaneously see increasing yields at the same time that the dollar falls. And that is like, that's what we're seeing right now. And that's kind of the bad outcome. Usually people run into bonds and yields go down and the DXY goes up. Dollar gets stronger. Kind of seeing the opposite. The dollar's getting weaker with the yields going up, which means that nobody wants dollars and they don't want the bond market. They don't want bonds. Crude oil is going to be the epicenter of it all. And gold and silver are going to go vertical. They are going to go vertical goose because it's the last thing that can preserve and store wealth. And if everyone's looking to exit the bond market, which they are, they're not going to go to the currency that's declining. So if and when interest rates go up, they're going to have to print more money. More money starts coming into the system. It puts crude oil into a shortage. Crude oil is going to go way up. Interest rates will go up too. And then people are going to say, get me out of the system. Hasn't happened yet. It's coming. I can't tell you what the transition looks like. Joseph Brown says these cult members blindly allow their political ideology to control every aspect of their life, including how they invest. I never take financial advice from a clown like you, to this guy says. I think Joseph Brown's actually pretty good. And I think Justin Hune, I know some people, he's getting a lot of slack, people are coming at him too. I saw him like calling him a clown or whatever. And here's the thing, guys. I don't think anyone can accurately predict something like this event coming. There was a lot of leading indicators that didn't look that bad. U.S. construction employment hasn't rolled over. Housing starts were going up. Those are all leading indicators. Leading indicators that a recession was not really coming at us. But something that comes out of left field, like a news event coming from Trump, which I hate to say it, guys, I don't think there's been a single event like this that news has been released or actions have been taken by a government and that has impacted the stock market anywhere near this type of movement. We can look at larger selling pressure, moves like the Great Financial Crisis and the Depression and the dot-com bubble. Those were all like organically driven by the markets. There are huge imbalances. Yes, we have imbalances today, but it wasn't triggered by a news event that came out. And with the uncertainty that was injected, this was almost like it was planned. the markets did not look like they were, well, some markets were rolling over, but they didn't look like they were going to crash. But that's what happened. White House secretary says 104% tariffs went into effect on China. Additional tariff will be collected starting April 9th, Fox Business Reporter. That's a tariff war. Here's Kevin Bambro. He says, the fact is, gold since 2000 has outperformed 99% of fund managers and 99.9% of bond managers. Gold is a store of value because it always has uses and it takes a lot of energy to make it. Anyhow, as much as I love gold, I love silver even more. I like both, guys. I like precious metals. No doubt about it. Josh says at least AECO, which is the Alberta Alberta Energy something. I can't remember the name of it. It's up in Canada. So the AECO natural gas prices are rebounding as expected. Drilling activity declines. So at least we're getting the higher. I mean, this is substantially higher for AECO natural gas prices, which is kind of weird. It's kind of weird because I mean, everything's getting sold off, but AECO's going up. I mean, in 2026, we've got AECO above 350. That's incredibly high for natural gas out in Canada. We were chugging along like $1 for a little while, and then they've got the LNG terminal coming up too, coming online, 2025. The riskiest time to invest is when the market looks the safest. The safest time to invest is when the market looks the riskiest. Here's Besant. He says, the little publicized story this week, everyone wants to look at the stock market going down. And do you know what else went down? Oil prices went down almost 15% in 2 days, which impact working Americans much more than the stock market does. I mean, is he just coming out and admitting what he's doing? I mean, are these guys just aiming at oil and saying, you know what else went down? Oil did, and that's going to impact people who don't own stocks. Well, no crap. If they don't own stocks, obviously it's not going to impact them if the stock market goes down. But he's coming out here bragging like, hey, look what we did. You know what else went down? Oil prices. And obviously, I I think oil is going to go way higher by the end of the bull market, way higher. These guys are going to send it to infinity. And the reason I say that is because we're already below the cost curve right now. So drilling's pulled back. All of the metrics we look at, drilled uncompleted wells, frac spread, everything's down. We have low inventories. If these guys mess it up, if they try to print money, they're going to send oil to the moon because the strategic petroleum reserve is down too. So how are they going to keep it down? This is all short term. Trump signing deals as bullish stocks. The charts almost always tell you the news before it hits the wire. Price signals over news signals. And using news signals, I mean, that's completely worthless. This is what they do. These guys have insider information of when this news is going to be released. They front run the news. So you can see it in the pricing of the stocks before it actually comes out in news. And whenever you start to see things either breaking up or down, usually news is released right after the breakout. So these guys front run it. They front run it. It's one big controlled market. They control interest rates. It looks like they're trying to control interest rates. It looks like they're trying to control energy. And they're starting to lose that grip on yields. You can see it. You can see it, that they're losing that grip. And if they've been manipulating yields lower and they lose grip, I mean, you could see yields moonshot. They could moonshot. Dow gold equals 1. It says median home price in gold has broken down from a bear flag. I expect price to be cut in half before it's over. That actually happens during housing bull markets. So when the housing bull markets go, you usually get inflation. It's a larger demographic. Home prices go up, but gold goes up faster. So this is an indicator when this goes down like this, that we're actually in a bull market for not just gold and commodities, but also for the real estate market. You can see here, we can look at some of these. In 2001, 2000, we had a big move lower. We have another big move lower from 2023, big move lower in the late 60s all the way to 1980. So yeah, this is absolutely normal during during a strong economy with um, increasing home prices. Now, does that mean that we can't get a slowdown here in the short term? Definitely possible in the very short term. Massive bounces in all asset classes today. Context is important. Most of these are now in strong downtrends and below all key moving averages. The charts were severely damaged in recent days. Buying these outside of a quick trade is a losing strategy. There are, however, still some asset classes with strong price structures holding long-term uptrends. This is where your focus should be. This is the distribution of U.S. investor exposure. It says it's at Warren Buffett time, and this is risk off, and the latest one is minus 40. So generally, you want to buy the tails here, or well, this left tail. The right tail you want to sell. Risk on and risk off environments. Another one from Dow, gold equals 1. It says, while the masses are screaming tariffs are causing a stock crash, recall that Dow Jones gold ratio broke down before Donald Trump took office. When tariffs are pulled back and stocks continue to slide, they'll all find a new narrative. You don't need a story, just a good chart. So what he's saying is, even if they pull back tariffs, you could still see a massive decline in the stock market against gold. It doesn't matter what they do with tariffs; it's not going to reverse it. Peter Brandt says, I will post this chart maybe only once, then you make up your own mind. 1929 top, 25 years until meaningful new highs. 1966 top, 17 years, ditto. 2000 top, 13 years, ditto. 2024 top, why not maybe 7 or so years, ditto. Got a better narrative? No, that's it. This is the commodity bull market. Stocks trade sideways for a period of time, and then commodities outperform. We are in a commodity bull market, and this is exactly commodity bull market 1, 2, 3, and commodity bull market 4. They're all commodity bull markets, guys. Every single one of those yellow shaded areas, they're all commodity bull markets. The great restructuring of 2024. I agree with that. Today is a tell your grandchildren I was there day in the bond market. The 10-year yield at its low today, which was technically last night, it was down 12.5 bips from Friday's close at 3.87%. It finished the day up 19 bips from Friday's close at 4.18. Instances when the 10-year was down at least 12 bips intraday and closed higher by at least 12 bips the same day. Intraday 10-year yield data set on October 16th, 1998, commodity bull market, that's the beginning of commodity bull market, almost 27 years. Only 3 times, January 23rd, 2008, the reaction to Rogue Trader losing Society General 5 billion euros. This was a big deal. November 9th, 2016, this was the day after Trump won the election. The low was early the night before election night. And then April 7th, 2025 is today. So there are too few examples to discern market direction. 2008 was down and 2016 was up. Rather, it tells us the bond market thinks today was an extremely important day. How? For now, we can only speculate. I believe today we learned what a recession with high inflation or stagflation means. Stagflation recessions now yield between those two. That's it. When the recession is removed, stagflation becomes inflation. And a 4% 10-year yield is way too low. Want to see yields lower than 3.85%? This requires the economy to sink so far that it kills inflation, turning stagflation into just a recession. At its worst this past week, no one thought the coming recession, if we have one, I have my doubts, in his opinion, would be this bad. So the market is priced in a stagflation recession, and that is 3.85 to 4%. Lastly, regarding this chart below, the next Fed meeting is 1 month from today. Last night, at the opening of the trading, Fed fund futures were pricing an 85% probability that they would cut rates at the meeting. Right now, 15% for no move. It closed with just a 33% probability of a cut and 67% of no move. Not only was the cut priced out today, but this kind of range is in probabilities for a meeting a month away is unprecedented. The uncertainty is hitting everything. Crazy, 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 crazy. So that's where I'm going to end it, guys. That's what I've got for today. So give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. I just released a midweek update, so you guys can look at that. And that's all I've got for today. So we'll catch you next time. This is Finding Value.